Welcome to the Global Pulse, a short video series where our experts break down a trending topic in international business and why it matters to you.
Recently, the dollar's resurgence has created a headache for the rest of the world. The dollar has increased in value lately, primarily as an effort by the Federal Reserve and the market itself to fight inflation. As a result of both monetary and fiscal policy in the United States, over the last several years, inflation has increased to a much higher level than the Federal Reserve and monetary policy makers in our country, in the U.S., would tolerate. They are targeting a 2% inflation rate, and right now, depending on how it's measured, it's somewhere in the 3 to 4% range. The higher dollar is resulting in higher interest rates, and the higher interest rates sort of carry over in international trade in the sense that U.S. citizens with the dollar are actually better off. With a stronger dollar, they can purchase foreign imports at a lower price since the dollar has greater purchasing power, and go on trips to other countries at a lower cost since the dollar could purchase more in the foreign currency. However, from the point of view of those other countries, in order to protect their own currencies from sinking too far relative to the dollar, as money would flow to the United States because of the higher interest rates, those countries in turn are forced to raise interest rates to try to support their dollar or use it to support their currency, and they would use their reserve currencies in dollars to support their own currency by purchasing their currency to try to stabilize the relationship. But as interest rates, in effect, are going up across international economic markets and financial markets, a recession can be induced both in the United States and in other countries as well. This problem will probably not get resolved until interest rates in the United States stabilize, that it's acknowledged that they have peaked, inflation has come down to the target level being sought, at which point the Federal Reserve is likely over the next year to start cutting interest rates a little bit, and although they manage short-term rates, generally long-term rates follow along.